Hello, this is Mike Swanson. I run the website WallStreetWindow.com, and the odds are that you're watching this video because you got an email from me, excuse me, telling you about it because you're on my email list. Now, if you're not on that email list, go below the video to the description, click the link to join, because then you'll get all my future market updates. It's an interesting time right now in the markets. I want to talk with you about what I'll be watching this week. But first, we got to remark on this list of stocks that I talked about in a video last week. They include Apple, Microsoft, Amazon, Google, and Facebook. Now, I was highlighting these stocks as ones likely to lead the market this week, and they're doing that. Now, I said this not because I particularly like these stocks. I don't even own them, and I prefer other things besides these stocks, actually, for the long run. But there are two things that were going on that made it kind of obvious. One was that all these stocks report earnings this week. Traders like to buy ahead of earnings reports. It's a buy the rumor, sell the news type of play. Now, when I talk about traders, I'm not talking about the random person with a Robinhood account, but hedge fund managers and even trading robots that big money uses. It's a historical play that kind of always comes in. Traders buy ahead of news, and then they'll sell and take profits often when the news comes out. So big thing to ask, and I'll be watching for this week, is when these stocks report earnings, how will they act? If they gap up, will there be enough people in the market who see the gap up and buy to keep them running for the rest of the week? Now, today, we saw Elon Musk talk about Dogecoin and Bitcoin gapped up on the open on rumors that were spread that Amazon's going to start to accept cryptocurrency payments. It was a big surge for several hours. So people bought into that. Will they buy into this? If these stocks report earnings and gap up on an open, will there be enough people to have enough buying power to outdo the hedge funds, institutional players, and so forth that are doing a buy the rumor, sell the news play? That's what I'll be watching for. And I've talked about how these stocks are also leading the market out by themselves, and in fact helping the market averages do well since the dump that ended last Monday. And I've charted this out and why I'm watching this and why it's so important to keep our eye on. Now, I'm going to talk about a trade I actually put on, a small trade, because I reduced my exposure in my accounts 2 weeks ago. It doesn't mean I'm all in cash. Doesn't mean I think the stock market's going to crash, but I do that occasionally. And almost everything I own, I bought a year ago. So I'm not looking to do giant buys either. I'm already got what I want. But I did do a small trade in the currency market. I'm going to show you that and talk with you about the second thing I'll be watching this week. And that's, what does the U.S. dollar index do once the Federal Reserve reports earnings? Actually, these stocks report earnings on Tuesday and Wednesday. The Federal Reserve, their meeting is on Wednesday. What will the U.S. dollar index be doing going into the end of the week? What will these stocks be doing when we look at things on Friday, too, for that matter? So it'll be a very interesting week. Tuesday, I had not much to look at. I'm maybe looking to see how things act after Wednesday, basically. But the U.S. dollar index spiked up to 104, made an epic top last year when the market crashed. People, this resulted, this spiked, and it peaked, and it declined into January, bounced up to above 93, then came back down and bounced back up into resistance now. And it seems to be losing steam. Now, and at the same time, commodities, for the most part, have seen, they pulled back, and then they seem to put in a bottom in the past 2 weeks. So this looking like the loss of momentum in this dollar rally that happened since June moved from 90 to 93. It's a small move, but it looks like it's coming to an end. Look, the momentum in the economic growth appears to petered out. That's why the yields in the treasury bond market have come back down. The 10-year treasury yield has gone below 1.3. Surprising to me, I was looking for a decline in the yields, but not one that big, but it happened. It's sending us a message. What does that mean? It must mean something. The only real economic interpretation you can come out of that is, they're looking for the economy not to be rapidly as growing as fast as it has been. The peak momentum was enormous. It was going to, it's 0 to 100 to maybe not 100, 0 to 70, whatever it was, that momentum wasn't going to continue from 0 at that rate. So it appears to have petered out. That's an explanation for why the yields are coming down. That can affect the US dollar index and make it peak and roll over on any signs of economic weakness, and which would all be bullish for gold. The US dollar goes down, gold tends to go up, but so do other foreign currencies because they trade against it. So I took a trade in this FXF. It's an ETF that tracks the Swiss franc, and it looks like it's in a very short-term trading range. 98 support, 99 and a dime or so resistance. So break that up to the upside and we can make a run up to maybe 103. So that's what I put a small trade on. And we'll be looking to see how this does. But gold, to turn to that, gold made a double bottom in March after having peaked around August, rallied into June and came back down. It appears to be going through a similar stabilization phase as it did in March, which will eventually lead to a turn up, a new rally, and that rally could start by the end of this week. But for the rally to be confirmed, gold must close above 1825. A close above 1825 will encourage technical traders to get on board. Now, I don't need that encouragement. I got a gold position. I bought it last year, and I consider it to be a core position in my account. I also own various mining stocks. And the most important indicator when it comes to gold is the GDX to GLD ratio. It tracks the performance of gold stocks relative to the metal. It tends to be a leading indicator in both. That indicator was positive today and appears to be making a double bottom. It's firmed up over the past week, making a double bottom off the March low. So that indicator is conductive for gold stabilization, eventual rally. So again, we want to see how these things look by the end of the week, by the end of Friday at the latest. But Tuesday, not looking for much of anything meaningful to happen in the markets at all. I don't think any sense can be made out of it a day before the Fed meeting and before all these stocks report earnings. So now it's really these guys in charge, the people that are buying these stocks, the big money that buys these stocks. And the small guy, the Robinhood guy, they're chasing crypto. There's some interesting things that come out about Robinhood last week because they're doing this IPO roadshow, having to release more disclosure, more SEC filings. Well, they revealed that 40% of all all customers' trades are either going into the options markets or crypto. High risk speculation, over 90% of options expire worthless, and crypto is about the most volatile thing you can put your money into. So, that's the mentality of the Robinhood trader. I'm doing the opposite. I pared back many of my positions, overall my account allocations in the stock market 2 weeks ago. I did a little bit of buying in the Swiss franc today, but something about the Swiss franc that is interesting is that historically over 100 years, I think it's 200, it's the least volatile currency in the entire world. And so it's a very low volatile asset. Gold is an asset that has less volatility than the stock market, much less Bitcoin. One reason I got it as a core holding in my account. It's very difficult for bonds to act as pure, to put half your money in bonds. Very difficult to do that when they yield absolutely nothing. And when they're so, the yields are so low that they're below the rate of inflation. When you buy bonds, you're guaranteed to lose money if you hold them to duration nowadays. That sucks, but that's the way it is. And that's why other asset classes such as gold is becoming more attractive to people who want a defensive allocation in their portfolio. The Swiss franc can also provide that. Gold's better, but the Swiss franc will go up when the dollar goes down, and it is also an asset that has very low volatility to it. So that's what I'm looking at here and what I'll be looking at the rest of the week. Not looking for much to happen tomorrow that we can draw any meaning out of. I don't expect to do a video tomorrow for that matter either. So be talking with you later. Oh, if this is the first time you've ever seen me on the internet or on YouTube, then what you ought to do is click the subscribe button on this YouTube channel, then click the bell next to it, and then YouTube will send you a notification when the next video is up so you can see what we're talking about. You can see what charts I'm looking at, maybe the next trade I do. So I'll be talking with you later.